Hi, I'm Andrew Kirsh, co-founder of Sklar Kirsh. On this podcast, I interview industry leaders. You'll hear their real-time opinions on today's market, their background, unique career highlights, and guidance for newcomers to the industry. This is the Kirsh Connection. Welcome to another edition of the Kirsh Connection. First, a shout out to my son Maverick and his teammates on the Santa Monica 9U Mustang All-Star team. They are one of the final 16 teams still competing between Santa Barbara all the way down to the Mexican border. They are in the Super Regionals tournament in Camarillo that will be played after the 4th of July weekend. Good luck to them. On this week's show, I have Benji Miller, the founder of Negresco Real Estate. Now, many of my guests have had several decades of real estate experience, and they tell their war stories and how they started their company and liquidity events, etc. But I have so many clients and peers and colleagues who are in a transitional flux of their career. They may be at an institutional job for several years, and they just don't know how to make that transition to the entrepreneurial world, where I wanted to have a podcast with someone who recently has made that transition from an institutional job to betting on himself and being very entrepreneurial about that. And so Benji comes onto the show to talk about what it was like working in an institutional job and then transitioning to working for himself. So I hope you enjoy my conversation with Benji Miller. Welcome to another edition of the Kirsh Connection. I'm here with my good friend, Benji Miller, founder of Negresco Property Group. Benji, how you doing?
I'm doing well. How about yourself?
It's good that you're in the studio. Thanks for making the drive up the 405 freeway from Orange County, right?
Correct. Irvine. Yes.
I just got my son's all-star baseball tournament schedule for next weekend. Will be in Dana Point, not Memorial Day weekend, but the following weekend. So I expect you to come and
absolutely
cheer on the Santa Monica 9U all-star team.
There's a really nice walk around the water on Dana Point that you should do if you get time in between innings.
All right.
Check it out.
Well, by the time this publishes or drops, as the kids say, we'll know if we won the tournament or not.
All right. Well, good luck.
Yeah. So glad you're here. As we were talking before we started rolling, I said, most of my guests are probably in their 50s or 60s and have talked about the lifeline of their career. And I wanted to get you on to for those in my audience who are, in their younger to middle innings, I guess, of their career, 20s and 30s, to hear from someone of their career path and how they've fared in the real estate industry. But before we get into what Negresco is all about, talk about where you grew up.
Sure. So I'm originally from Tenafly, New Jersey, which is northern New Jersey, right outside of Manhattan.
I thought that was a made-up name,
Tenafly, correct.
All right.
Yeah, it's about 30, 40 minutes outside of Manhattan. Everyone's parents work in the city. Grew up on the East Coast, and my background is in high school, and this kind of ties into my career. I have a little bit of an unorthodox entry into the real estate business, but I was obsessed with basketball growing up. That was my entire identity.
I could tell based on your height. I think you are probably 2 feet shorter than Wembanyama.
Maybe, yeah, exactly. So definitely not a unicorn, but I really wanted to pursue basketball. I ended up getting a few offers to play in undergrad. Realized pretty quickly that I didn't want to do this long term, at least in college, and I knew I wasn't going to play in Europe and definitely not professionally anywhere else. So my kind of bridge to all of that was I actually wanted to be in the sports business world. So I thought, my give here was let me either be on the representation side from a wealth management perspective or actually be an agent. And I ended up going to University of Michigan undergrad, which we can dig into, Northwestern alum.
I'm not even going to say go blue.
Yeah,
I guess I did.
Exactly.
But,
and I actually interned at Bank of America in the wealth management department, but ended up post undergrad working at a sports agency and kind of tried to fulfill that dream. I was very much low man on the totem pole, Lloyd from Entourage type.
That's a great reference.
Yeah, without the expletives. And I was doing everything from ordering lunches to driving our athletes and professionals to Yankee games.
So this was in New York?
I was in New Jersey, New York,
okay.
actually. Yeah. And just realized that this was not going to be a full-on career path where I could support a family, and that I was really passionate about.
So I'm glad you mentioned that, because I feel despite my having my name on the door of this law firm, I have always felt that I should have gone into sports.
Yeah.
And now you, Benji, have relieved that FOMO and anxiety that my life was unfulfilled, because I have told everybody that I should have been in sports management.
Right.
You know, I was a college baseball player and still very passionate about sports and the business of sports. So maybe I did make the right choice.
Yeah. I knocked that out for both of us.
Thank you.
It was a really interesting time. You know, at least if you're working in investment banking, you're getting paid a good amount. I was making minimum wage, just doing the grunt work and learning the business. You know, I actually, gained some good soft skills and kind of advanced within the space, but knew that I needed to pivot to something that was, how should I say this? It just had a future. I didn't see myself or my boss or my boss's boss, and I didn't want their lives. And I started to do with my dad an internal audit of my network, my family's network, and from my fraternity brothers at University of Michigan and different people within our community, it kept coming up that real estate was just something that had some legs. I had some of the soft skills and personality traits that could, help succeed in the business. And a lot of my friends were working at the Relateds of the world, SL Green, CBRE, and I ultimately thought, if they can do it, so can I. I've been, these are my contemporaries for the last 5 years. So I, worked through people in my network, and I wouldn't say reconnected because I had known him my whole life. I spoke with Michael Hackman of Hackman Capital, and he effectively gave me a shot, my first shot in the business. And it was kind of a 3-month window and kind of make or break, let's see what you got sort of situation.
This was after college graduation?
This is after college graduation, after working at that agency.
Yeah.
So it was about a year and a half after I had graduated, realized I was making a pivot into another business that I had never had any experience in.
By the way, we'll get into your time at Hackman.
Yeah.
One last sports story, because I can't get off it, especially now that the Knicks are in the Eastern Conference Finals. But my closest friend from law school and my early days of Latham is a guy named Darren Ehrman, 5'7" Jewish kid, just like ourselves, who had a passion for basketball. After 5 years of being a lawyer at Latham, decided he wanted to pivot to go into sports.
Yep.
He got a job with Bob Hurley Sr., the head coach of St. Anthony's. Adrian Wojnarowski at the time was writing a book called The Miracle of St. Anthony's. It was all about Bob Hurley Sr., but there was a chapter devoted to my buddy who, the writer, Adrian, said, I can't believe here's this guy who gave up a 6-figure career to become a 5th assistant coach at this inner city Catholic school, and here's this Jewish kid being a basketball coach. Fast forward later, he's been in the NBA for well over 15 years, won a title with the Celtics, has been to playoffs almost every year with the Warriors, the Pelicans, and the Knicks, and I don't know, making a career out of it. So
I told you my Hurley story too, I think.
Bob Hurley Sr.?
No. Oh, Danny Hurley.
Oh, Danny Hurley. No, I don't.
So I can get to this quickly. You could leave it in or out if you want. But basically, when I was working at that sports agency, my boss was the old athletic director of Wagner College. And he finally brought me in to do a really interesting project after I was working on things that were quite uninteresting. And said, look, I used to be the AD. I'm helping run a college coaching search. Can you put guys on a list that have, really good recruiting chops, can recruit New York and New Jersey, and are good up-and-coming college coaches? Wagner College is a low to mid-level D1 school, and if you do well there, you propel to the next level and then hopefully get a job elsewhere. So I put a list together, and I had one guy that I put on the list that was this really bubbly guy who was New Jersey royalty, but he was a high school coach at the time. And I put him on the list, and my boss said, yeah, we were thinking about him. And I said, I think he fits what you want. Why don't you let it rip and see what happens? So he comes to the office. He has all this energy. He ends up getting the job, does pretty well, ends up making the tournament, I think 1 or 2 years, ends up going to Rhode Island the next year, then, makes the tournament there, moves over to UConn, wins 2 national championships. And the moral of the story is I helped hire Danny Hurley.
There you
go.
So I hope he thanks you.
Yeah, he doesn't remember who I am.
Okay.
He has no idea who I am.
I
wasn't in the meeting, and I don't purport to, having the final say, but I definitely proposed that.
That's an amazing story.
Yeah.
That's great. All right, should we just end the podcast now?
Yeah, seriously. We don't need to talk about anything else.
All right, so what years were you at Hackman?
I had 2 stints at Hackman.
I
came in 2011 or 2012 until 2015, which I refer to as Hackman 1.0, at least for me. I went to business school and did my MBA MRed at USC from 2015 to 2017. Came back after that from 2017 to 2020. I worked at Hackman.
Hackman 2.0. So 2.0. Hackman 1.0 was more of an industrial, equipment finance company, right?
Yeah. So I learned the industrial business through Michael and a bankruptcy attorney and our head of acquisitions. I focused on what we would refer to as real equip, which is real estate and equipment, bankruptcies, plant closures. Worked on some really cool projects. The first deal where I kind of learned everything, because it was like 100 deals in one, was we bought the bankrupt Hostess estate, where we bought a series of bread trucks, facilities, bread locations, warehouses, and we sold off all of them, as well as the equipment along the way. But I learned the entire business from that transaction.
No, that's amazing.
Yeah.
And then 2.0, were you guys then getting into the studio business?
Yes. So prior to going to business school, we bought Culver Studios, and we were starting to buy infill industrial that had a higher and better use in our infill fund. So there were some deals in Culver City that were warehouses, one of which in the Hayden Tract ended up getting leased to a small company at the time called Beats by Dre, who eventually got acquired by Apple. So then there was Apple credit, bought those. And, I started getting more exposure to the office world. When I came back post-grad school, we were buying a lot of studio assets, but we still had our urban infill fund, which is where I focused a majority of my time.
And so when you read about what, the headwinds that Michael and Hackman Capital are going through, I don't know what goes through your head, having worked there for almost a decade.
Yeah, I would say that Michael will make it work. I mean, he will make things happen. He's one of the smartest guys I've ever met. He is hardworking. He can pivot and make things happen within a situation, and I'm confident he'll figure things out.
Yeah, yesterday we actually recorded a podcast with David Alpert, who's the CEO, co-founder of Skybound, and who produced The Walking Dead, and now has a show called Invincible that's well regarded on Amazon Prime. And we talked about just the entertainment business as a whole. Victor Coleman was in your seat, and he talked about just how LA has essentially turned its back on the entertainment industry, or just hasn't given it the support with the the city assumed that everyone would just produce and shoot shows, movies in LA.
Yeah.
And people can move in their transit, and you can go to other parts of the country or other parts of the world that will offer tax credits. And our local and state government has been slow to react, and hence we are now seeing the fallout of what Hackman's dealing with, what Hudson Pacific's dealing with. All right, so let's do a deep dive as to what Negresco
Sure.
is doing. So for my audience that may not know.
Sure. So Negresco Property Group is an iOS-focused firm, owner-operator here in Southern California. We buy anything 3 to 50 plus million, 1 to 20 plus acres in Southern California, which in our eyes means anything in Los Angeles, the Inland Empire, Orange County, and San Diego. My thesis is I'm 90 minutes away from all of my locations within the fourth largest economy on the planet. I have intimate knowledge of these markets and the people that help move these goods in the markets, just based off of the amount of time I spent in the industrial business, going to USC, and being in these markets and kind of living and breathing all aspects of those situations.
So, coming out of COVID, I think it was the first time I ever heard iOS. I thought they may have been talking about the operating system of our phones. And every deal and every client of mine, iOS. And this is probably 2021 to, I don't know, maybe late 23, early 24. And then I have been handling iOS transactions, but not nearly at the pace that we were handling the first part of the decade.
Yeah.
Talk about why, how is my perception correct?
It's correct.
And then, so what has happened
to that?
I
would refer to as 2021 to 2023. Someone used this term, so I can't coin it as my own, but people refer to it as the go-go days. Like you buy a deal for $70 a foot. 2 weeks later, you get an offer for $100 a foot. You rejected that and got another offer for $110 a foot. It made no sense. And you could take any industrial site that had somewhat of a yard and just rebrand it as iOS, and people would, try to throw people to the side to get new opportunities. I think the run-up got kind of crushed a little bit by the rise in interest rates over that time period, and has washed away a good amount of people in the business or who are no longer focusing on it. I think also in that phase, you had a lot of people who focused on office, who kind of understood that was having its challenges and capital needed to be placed in other directions. And this was an up and coming alternative, which, there was and still is a good amount of data that shows that alternatives are outperforming the core for asset groups. So, it was a really big run up. People weren't necessarily doing a good amount of diligence on their land use or what tenants really needed. And that kind of settled in 2023. Now I refer to it as iOS 2.0, let's just say. And iOS 2.0 is much more efficient, not fully efficient because, comps are still not available on CoStar, but people understand the game now. You can't just push something across the field and expect someone to not talk to their land use council and talk to the planning department or someone on the other end to verify certain uses. There's a lot more data out there on comps and specific subclasses of those comps. Maybe you got a comp for a sales service and delivery center that may pay more versus an equipment rental facility versus trucking or drayage. Like, you just don't know until you get all of the data. So I think a lot of people are functioning with much more information now, and the specialists are really leaning in.
Mm-hmm. And so is your business plan more of a covered land play with the hope that you re-entitle and sell to a user or developer for a higher and better use? Or is your business plan of, you have a tenant that the lease may be expiring and you get another tenant that will pay a higher base rate?
Yeah, I think we're staying within the iOS world as far as like what happens next in the second generation. So another thing that I should mention is currently I'm in a co-GP relationship with a group called Open Industrial. They're based out of Bethesda, Maryland, but their CEO, Michael Rabin, sits in the Valley here, and I work out of their office every Wednesday. And they have pretty great infrastructure with a full team of 15 plus people. And we're looking to scale the business, grow a portfolio out here, and that could be part of a much larger portfolio nationwide.
So you are looking beyond the greater Southern California
I'm
area?
not. So my co-GP partnership links on to their relationship. Whether or not we do a deal through specific equity or other equity is kind of on a deal by deal basis.
So how is the overall market? You've got tariffs that maybe things have stabilized there. The war in Iran, oil prices, where it's at, 10-year treasury, I think got even up to 4.7
Yeah.
recently as we're recording May 20th, May 21st. What is the overall market like for iOS today?
I would say it depends. Each site is created differently. The more infill the location, I think there's still a good amount of demand, but it's all about the bid-ask spread on the sell side. So your land basis is dictating everything, and obviously your rents are, part of the equation. But I would look at this, at least on our side, we're looking at this as more of a sharpshooter opposed to a pie eating contest. We don't want to buy every single deal. We want to buy deals that make sense for us in specific pockets that, maybe 3 years ago we saw were $100 a foot. Now they're 50. Do we want to buy into vacancy or not? It's a case by case situation. There are certain sub pockets that I focus more on just based off of, having seen more activity in the past. And we're kind of positioning ourselves that way because you could get burned in certain areas. There are comps out there that if you don't really understand what that comp means, you could apply it to your location, pay a land basis that doesn't make any sense, and then you're sitting vacant for 2 years and your deal's upside down.
Yeah. And what's average deal size that you guys pursue?
So average deal size probably around 10 million. First deal we bought was 20 plus million. But it really just depends. We're looking at, 1 to 5 acres, kind of the sweet spot. So just triangulating backwards from there, based off of land prices, you're anywhere from like 4 to 20 plus million, depending on the location.
So at those purchase prices, you have your GP, your
Yep.
co-GP relationship.
Yeah.
How are you capitalizing your deals from the LP? Because they seem too small for institutions,
Yeah.
unless if you do a programmatic.
Yeah.
Is it through syndications? Is it family offices?
Sure.
What's your profile of an LP?
So Open Industrial has a programmatic relationship with an institutional private equity firm. They also have a deep bench of other capital sources, as do I. So we go through the natural progressions of who has first look on certain things and try to capitalize it that way. One of the reasons why I partner with Open was beyond them just being great guys, they had the infrastructure as well. They were able to capitalize a fair amount of deals. And, in our business, one of my mentors always used to say, and there's holes in this argument, but you need to be able to raise money or find deals, or you can be replaced.
No, those are the two aspects
Yeah.
of real estate, or I guess asset manage.
Yeah.
All right, so let's dive into that further.
Sure.
Where, I have a lot of conversations with guys that I was going to say of your vintage, of your age, where they are at an institutional shop.
Yep.
Maybe like a Hackman, or maybe they're on the capital side
Yeah.
at a large capital allocator, and they're making a good W-2 income,
Yeah.
and they're fine, right?
Yeah.
They're doing well, but they see what their GPs are making, or
Right.
what other GPs who have been in the business for 20, 30 years are making.
Yeah.
And they've got all of this dilemma of, going out on their own, yet they're married and they have kids and a mortgage, and not having a steady income. And where am I going to, I may have access to deal flow, but I don't have access to capital. Or maybe I have access to capital, but I haven't really been on the ground with the brokers. And there's just this risk of what should my next move be. And I have these conversations with these people. So you've lived it, and it may seem like it's a path without any ups and downs, but I certainly know that there have been.
Yeah.
And so walk me through or talk to that person who may be listening to this podcast who is vacillating of whether to stay at that institutional job or to take the leap like you have.
That's a very good question.
It took me 4 minutes to ask.
Yeah, seriously. So I would say that it starts at home. You need to very much be on the same page with your spouse. I wouldn't have been able to take the leap if my wife wasn't working. We don't come from a significant amount of capital or, have a huge backstop or anything like that. So
what does your wife do?
She works in tech sales.
Okay.
Yeah. So understanding your internal cash flow, your burn, exactly, how much time you have to get to X, Y, and Z. Before I went off on my own, similar to probably what every person does behind the scenes, I put together a spreadsheet.
But before that, you have kids.
I have 2 kids.
Right.
Yes.
So I just want to frame the picture of
2 kids, preschool, Orange County. It's challenging. It's very daunting. I'm not gonna lie. It can be tough some
mortgage
days.
And schools.
Yeah, absolutely. So I created a spreadsheet that basically showed, okay, here's what I'm making at the last job I had before I went off on my own. Here's, if I got my bonus or upside, what it would look like. And I backed into it. I came up with numbers that, based off of these fees and this income, I could replicate X, Y, and Z. Being an S Corp versus a W-2, making this amount of money is actually the equivalent of making this amount of money. It's an inexact science. And kind of just understanding okay, if I can kind of cut this up into little tranches, what are my yearly goals? How much in new acquisitions, which is what I specialize in, do I have to do on a yearly basis to replicate that income? And I thought, okay, I've done this before. I was lucky enough also when I was in grad school, I had syndicated 12 apartment opportunities. So I kind of scratched that entrepreneurial itch and I'd round trip deals. So I had the confidence that I could do that, even if they were $2 to $6 million opposed to $50 million. It's the same muscle that you're flexing. So you kind of really need to understand your burn, your run rate, and then at some point, and this is the problem because I get reached out to by a lot of people in the business who have very similar questions. And at some point, you kind of just need to burn the boats and just do it. No one's going to have the perfect situation for you. I know people want to jump if they have a certain salary with deals already in place, but then they don't get the value of what the business is worth at that point. It's a dicey thing if you have people come in later on to a business that's already established. So you really just need to let it rip, as I said before. You need to jump in at some point, but it's scary. There's no way around it.
And in terms of capital raising, which I think is probably the harder aspect of the two, of sourcing deals, maybe you would disagree, I don't know, of sourcing deals and capital raising. Now, some people say, hey, I've got plenty of capital, I can't find deals. Now, maybe that's not because of them specifically, but just of the market, right? That they're not finding deals that are worth pursuing. But just focusing on capital raising, going through either a joint venture structure and execution where you're having one group essentially telling you what to do versus a dozen to 2 dozen high net worths, each putting in money, from, I don't know, 50,000 on the low end to maybe $500,000 on the high end. But, you're chasing cats and dogs and it's challenging from a reporting perspective and just a time perspective. Do you have an opinion as to the path that is better?
Well, I think you kind of have to back solve for what you want in the future. If you're looking to build a portfolio, having a programmatic equity relationship is great. The downside that a lot of people don't talk about, but everyone knows, is that your deals could and probably likely will be cross-collateralized. So if the first 9 win, but the last one loses, you worked for free. So while you are hurting cats and dogs, as you referenced on the syndication side, there are benefits to having each deal kind of live in its own ecosystem. When you're first starting out, I think most people are just happy to be in the game. They want to, I don't think that this is always the case, but people will take some of the first deals that come to the table. And sometimes people won't branch out on their own until they have capital, or vice versa. Like, it really just depends, but you need to be very mindful of what each situation means. It all comes with strings, as you know. Mm-hmm. You're writing the contracts.
No, for sure. And in terms of, I mean, each asset class will dictate the type of capital that you can go after. iOS is a smaller purchase price, like you were talking about. It's hard to get institutional capital focused on smaller deal sizes. To get a programmatic relationship is the holy grail. It's challenging to find that. So, as we're approaching mid 26, and interest rates have not really come down as people expected, probably because of the war. The phrase was stay alive until 25. I think I was doing a podcast a couple weeks ago, and we said something. What was it about heaven? Oh, it'll be heaven in 27.
Okay, I can run with that.
Yeah, you can run with that.
Yeah.
So, what is your? Are you able to make things work in today's, I guess, interest rate environment and today's economy? And how are you able to put the pieces together? Because half my client base are surprised that I'm doing any deals, yet I am very busy in our transactional volume.
I think there's definitely a bid-ask spread on deals, but it's a numbers game. You may offer on 100 sites, pick up one or two, and that could be your year. It's just the nature of the business, and it's tough to really function in that environment. But one thing that I tried to really focus on this next tranche of deals that I'm buying is try to aligning with partners in capital that can live across the risk spectrum. So you're investing through a variety of different time periods. Having core plus, and value add is a huge benefit. There are several cash flowing opportunities that were never a thing 3, 4, 5 years ago that are now coming up. Now people are overinflating sale leaseback pricing, so that's a little bit of a challenge, but there are pitches that are coming down that are different than what we saw before, and a lot of it is being able to pivot through the structuring angle of the business as well.
So when you say cash flow, like what type of cash on cash return, or?
It just really depends. I mean, I think we're seeing now that there are some industrial deals that are trading in the 6s day one.
Okay. On a cap rate, or?
On a cap rate. Uh-huh. Yeah. So, and they could have anywhere from 5 to 15 years of term. And there's not many of those, but there are some. Brokers are pricing deals in the 5s for certain credit, but depending on term and all the other intangibles, they're shifting accordingly. So, the key is to still be in the game, still offer, because you really don't know what the bid-ask spread is until you're there.
And you met, obviously, Southern California, the 4th largest economy in the world, like you were talking about. City of LA is certainly having its headwinds, and you don't transact in the city of LA, it's the surrounding cities. But overall, Southern California, is there a concern that it being sort of the global industrial hub is going to dissipate over time, and that there are other great industrial micro markets throughout the country?
Yeah, I mean, that's always a concern, being focused on a specific location. There are risks to that. But, it's a risk I'm willing to take. I believe in the long-term approach, or not necessarily approach, but I believe in the long-term validity of California. I think that we've had challenges in the past. We're, hopefully going to figure all these things out. I don't know how in some instances. We can tap into that a little bit, but, it's a bet that I'm putting my family's livelihood on. So, I'm going for it.
So you've lived in LA.
Correct.
For how many years?
I lived
At
in LA.
the actual part. I don't consider Orange County LA.
Yeah, no, I lived in LA from 2012 to 2020, so
Okay.
8 years.
8 years. So
Yeah.
now, and you're in Irvine now.
Correct.
So after the fire, my wife had us moving everywhere from Nashville,
Yep.
Austin, Park City, San Diego, Orange County, and we ultimately bought a house in Santa Monica.
Yep.
Couldn't be any closer to the Palisades, right? But every day there's something that happens in LA that makes her say, you know what, we really should think about maybe moving
Yeah.
to Orange County or to somewhere else. So, you grew up next to New York. You spent a lot of time in LA.
Yeah.
Tell us about life in Orange County. It's another world, but
Yeah.
Because I think a lot of people today are really contemplating what the benefit of living in LA is when we're taxed so significantly, but yet is there an ROI on our tax dollars?
Yeah. Yeah. I mean, look, I had spent all my time building a network in Los Angeles. I went to SC, I worked at Hackman, I worked at First Industrial, and I wanted to stay within the LA ecosystem. And my wife was pregnant, and during COVID, we would go on a series of walks around Brentwood, and we were attacked by a homeless person right by San Vicente around I know that they've now moved people into the VA.
Yeah, but that was a bad time.
Yeah.
And where is she from?
She's from South Africa originally, my wife, but then they moved to Irvine. So moving to Irvine at that time, being closer to family, and she was pregnant, and there was actually a sick person in the family who's now better. But I basically said, if you want to move down, now's your chance. And I was not looking forward to it, and definitely felt very isolated down there. But I've learned to really enjoy it down there, and it's a great quality of life. I mean, the streets are clean. There's always parking. I know that oftentimes we're eating in a shopping center, and that turns a lot of people in Los Angeles off. But, I come up to LA for work once a week. We still have a lot of friends up here. I was in a group, CLI, through the Federation.
Sure.
So, I still have my hand in the market. I'm in the car constantly. So, I'm down in San Diego one day, then in the IE looking at one of our properties, and back up to LA. I'm all over the map, so I don't really feel totally detached, but I definitely have enjoyed the quality of life down there.
Yeah, it's something that I've resisted, maybe because of fear, that, being in LA, being in that ecosystem, wanting to be seen, and the chance encounters, the ease to going to some event, and when you are an hour and a half away in traffic or more, you're less likely to do that. But
Correct.
So many people coming out of COVID have made the leap well past Orange County, other cities, other states, and we live in a society where we're so connected through our phones and Zoom that maybe it almost doesn't matter where you live, and that you should just choose a place that's quality of life.
Yeah, I mean, look, everyone has their own decisions to make. It's challenging, especially if you grew up here.
Yeah.
I didn't have any connection here. My wife's family was down in OC. So it made it a little bit easier, but I definitely resisted. I didn't want to go. And now I'm definitely very happy down there.
We're going to end with one final topic quickly.
Okay.
My jealousy towards you and being a Michigan Wolverine.
Okay.
As a Northwestern Wildcat, I would look to Michigan as look at this great school.
Yeah.
Great sports. You guys all seem to have fun, and now you're enjoying the success of football and basketball championships. So is Michigan as great as everyone says it is?
Yeah, it's an unbelievable school to go to. I will mention that there's probably 3 or 4 dinners that you still owe me for Northwestern losses, but
I'll buy you a burrito after
there
this.
we go.
Yeah.
But yeah, we didn't really win much when I was in college. We were very happy to make the NCAA tournament, and we lost to Appalachian State my junior year. We weren't exactly as relevant as we have been recently.
Don't forget 1995 when you were probably just running around in diapers, Northwestern beating Michigan in football. How about that? Oh, you don't even know that, right?
No, I have no idea. Okay. But yeah, it's been awesome. And now with the Knicks being super relevant, I just need the Jets to win it all, and I can die a happy man. I don't see that happening anytime soon.
I'm pausing because it's funny. So my son's birthday is November 22nd. And I looked at this football schedule because his birthday's on a Sunday. I said, oh, great. Between the Rams and the Chargers, there's going to be a great team coming in. We'll do invite some of his buddies and we'll go to SoFi. So who's coming in the day of his birthday on November 22nd? The New York Jets.
Yeah, I'll see you there.
To play the Chargers. And he's like, Dad, of all teams, why does it have to be the Jets?
Right. Well, yeah, we're a long way.
At least you have your Michigan.
Of course,
football.
We'll take it.
All right. Well, Benji, thanks for making the drive. I know
Absolutely.
It's Wednesday, so you were coming up anyway. But I'm really proud of the success you've had to date, and I will be keeping tabs on you, and we'll do a 2.0 interview as Negresco continues to dominate in the iOS world.
Great. I appreciate it. Thanks for having me, Andrew.
You got it. And that's another episode of the Kirsh Connection.